So first thing I want to say is, as many of you noticed and pointed out, thank you for paying attention. There's kind of a mix-up with the grade book. All of your submissions are up there, but I went in. I'm still becoming familiar with the Canvas grade book, and in Blackboard it used to be really easy to like stop at a point in time to be able to tell at that point in time where all the students were, like for everything that's due up to now, how much, what the grade is, not including all the stuff that is yet to be graded and all that stuff. I have yet to figure out how to do that, but in my haste to try and figure that out, I clicked a box and I can't unclick it. But what it does is it counts everything that hasn't been graded yet, but that is due, or at least has had a due date so far. It counts it as missing. Don't hyperventilate. I know some of you already have, but don't worry about it. It will all get graded, and as long as you submitted it, it won't be a zero. But don't. So I'm in the process of going through those. You probably noticed there's more that has been graded, and then I'm unclicking that missing button as I go along. So don't freak out if you submitted something and it shows that it's missing. It's not missing, it's there. Unless, like I said, unless you didn't actually upload it and then it's not there and then it is a zero. All right. So any questions before we head on to chapter 15? Last chapter. Are we excited? No?
Sure.
Are you gonna miss it? Oh. I thought she was gonna say
Yeah. It's almost parts of it. I won't miss the tax act.
Well, Tax Act is done.
I know.
If you've done all there are no more Tax Act assignments. Those are finished for the semester. And you don't have any, the only other exam, like I said, is the one that we'll do in class next Thursday, and we'll go over there next Tuesday. We'll go over.
Jesus.
What?
No, I refuse to believe that it will be December tomorrow. Because I've procrastinated on so much stuff.
Yes. It's all come home to roost, hasn't it? Anyway, so yeah, which is why I try to have those deadlines regularly scheduled throughout the semester, because I know how students are. I'm the same way. If I don't have a deadline in front of me, it's going to get pushed to the back burner because I'm going to put out other fires first. Anyway, so our last chapter here, chapter 15, we're going to talk about corporations. We talked about partnerships last class. Now we're going to talk about corporations, and corporations are specifically formed as such within the states that they operate. So if you don't choose to be a corporation, you will not be a corporation. You have to affirmatively select and take all of the steps in order to do that. Remember, with a partnership, if you go into business with somebody, automatically you're considered to be a partnership. Well, that's not the same with corporations. You actually have to make some steps, file articles of incorporation with the state, which involves some filing fees. They're not really difficult to do, and they don't have to be terribly complex. But it is something that has to be, it's a company that has to be registered with the state as a corporation. There are lots of different types of corporations, though. So corporations can be for-profit corporations, which we call, in tax world, we call them C Corps, because, why do we call them C Corps? I don't know, off the top of my head. They're C Corps. We call those C Corps, but we also have nonprofit organizations are also corporations. It's just that they're corporations that have chosen to be organized as nonprofits, so not for profit, but they have to take additional steps then to become nonprofit. We don't talk about them in this class, thank heavens. They have whole different tax requirements, a different form, all of that stuff. But we don't do anything with nonprofits here. But they are another type of corporation. Another separate type of corporation. Oh, and the nonprofits are often, you'll often hear to them referred to as 501c3s. If you remember when we talked about charitable organizations, and I mentioned that code section 501c3, that refers to the code section under which most nonprofit organizations, charitable organizations, are organized within the tax code, right? And then there's a third type of corporation, specifically a third type of corporation. There are some other minor types of corporations, but one of the other ones that we are going to look at in this chapter at the very end is called an S corporation. S corporations are generally smaller businesses. They have a lot more limitations with regard to who can own shares in the corporation than C corporations do, but they have a different method of taxing as well. They have their own tax form, as do C corporations, but the S corporation form is different from the C corporation form. S corporation is kind of like a hybrid between a C corporation and a partnership. Okay, and you'll see that when we take a look at them. S corporations have their own K-1 forms. They are considered to be pass-through or flow-through entities like partnerships are. But unlike partnerships, S corporations have stock. Partnerships don't have stock. The owners are members of the partnership, but they don't have stock. They have an ownership percentage, but they don't have like shares of stock. Any corporation is going to have shares of stock. So S corporations have shares of stock. Also, unlike partnerships, S corporation owners can be employees. So remember with those partnerships, we talked about the fact that partners aren't employees. They don't get a W-2 from the partnership. They don't get a 1099. They are taxed differently. Any income, any salary, those guaranteed payments, any salary that a owner receives is going to show up on the K-1. But with an S corporation, owners can be employees and receive W-2s and be part of all of the benefits that any other employee can have in that as an employee. Okay, so that is one of the differences there as well. We're gonna, in this chapter, so we're gonna start out talking about corporate formation, which I already kind of alluded to a little bit. You do it through the Secretary of State's office. There are forms though that have to be filled out with the IRS also, and usually that's when a company is first forming and they fill out that I can't even think of the number, the W, oh shoot, oh I can't think of the name of the form that is used to obtain an employer identification number. My brain, it's lost. But usually there's and if in payroll tax we looked at that form, and there is a choice on there of what type of company you have. Is it a sole proprietorship? Is it a partnership? Is it organized as an LLC? Remember, that's not a tax entity, but the IRS still. No, it's a. My mind has just gone blank on it. Like when you can't remember how to spell the word "the" or something like that, you know. So you have choices on there of what type of organization your business is under. C corporation is one of those. S corporation is also one of those. So usually that formation happens right at the beginning, but it is possible for companies to change the type of organization they operate under. A partnership can become a C corporation or an S corporation, or a corporation can then decide that they want to become a partnership. Usually when you're going in that direction, it would probably involve dissolving the corporation and starting the partnership separately, but that formation usually happens, the very first step is filling out that form to get that employer identification number and registering with the Secretary of State's office in the state in which you're operating. We've got that word basis again, sorry. So basis though for corporations is a lot easier to understand than it is for partnerships, okay? So because we have shares, people purchase shares of a company, that relates to their basis in in the corporation. So it's a little bit more relatable, especially if you've ever had a retirement account or some type of brokerage account where you've bought stock before. So it's the same sort of concept. Corporate taxable income and tax liability, generally speaking, is determined pretty much the same, but there are some different rules for corporations than we have for individuals. A good example of that is, remember with individuals, capital losses can be taken up to $3,000 to offset other income. Corporations don't have that. They don't have capital losses. They don't get to take that to offset income. So that's just one example of some of the differences. Tax rules for transactions with shareholders, so that would include dividends or sale of stock, or if instead of cash being distributed, stock is distributed to the shareholders, or property is distributed to the shareholders. So we're going to talk about that. Schedules L, M1, and M3. Schedule L, that's easy. That is our balance sheet. Remember when we looked at the partnership return, we saw the balance sheet on the partnership return is just the same as the balance sheet for the on the books. But what's new are these schedules M1 and M3, and I've already alluded to the M1. That's where we calculate those book tax differences. That M1 form also shows up on the partnership return, and it shows up on the S Corp return. You've got to reconcile between the income per books and income per the tax return. So that's where that happens. M3 has to do with what's called an accumulated, can't think of it off the top. Again, my brain is I can't think of it. When we get there, I'll remember it when we get to that page. Other corporate issues, and then we talk a little bit. The chapter, it's kind of funny because the chapter spends a lot of time on C corporations, and it spends one unit or one learning objective on S corporations, when in reality, there are a lot of S corporations out there. S corporations used to be the way to organize a business for small businesses. It used to be the most popular way because there were a lot of tax advantages to it. Now, when they passed the new tax law in 2017, some of those tax advantages became, well, it's not that they lost their tax advantages, but other advantages were given to partnerships and C corporations that made those organizations more attractive, especially C corporations. The advantages that were given to C corporations were a reduction in tax rate. And there was quite a significant reduction in tax rate for C corporations that happened with that. So you don't see as many people organizing S corporations as you used to, but I will tell you that when I was practicing, I helped people to organize a lot of S corporations, even sole proprietorships that decided that the tax benefits were worth organizing an S corporation. The tax savings usually came in the form of reduced Social Security and Medicare taxes for the owner. But you don't see it quite as much, but it's still a pretty popular form of organization for businesses. Anyway, so that's our introduction. Questions before we get started here?